Look who's with us. A guy who I had a go at not too long ago. Bob Knakal, Cushman and Wakefield Investment Chair. Welcome back.
Good to be here, Stuart.
I was having a go at you because you would not admit that commercial real estate rents and their values have come down because of the trend towards online selling. I'm not going to talk about that today because I didn't get much out of you last time.
Okay.
Keep nodding, son.
Absolutely.
Okay. What would tax reform, tax cuts, do for commercial real estate?
Well, I think if you look at corporate rates and individual marginal rates, reductions in those would clearly be very, very positive. To the extent corporate rates are cut, companies could go out and hire more people. Those additional employees fill up more office space. That's good for real estate fundamentals.
But it would be an immediate boost to your margin, your profit margin, wouldn't it?
It absolutely would. But the question is, what are the trade-offs that will allow those cuts to come? And there are three main areas that commercial real estate is very concerned about. One is what's going to happen with depreciation schedules. They're talking about expensing 100% of the cost of capital investments in the first year.
You'd like that.
That would supercharge and overly juice the market to the point where we may get construction of new buildings that's unnecessary. And we had this in the early 80s, Stuart, when depreciation schedules were 15 years and the passive loss rules were very flexible. We had buildings built that were unneeded, and we had what we used to refer to as see-through buildings in the 80s, because people built them, you could see right through them, there was nobody in them. So that would not be a good thing.
Okay.
Second thing, which is very important for commercial real estate investment sales, is something called a deferred exchange, where you can sell a property and defer your capital gains tax by buying another property within 6 months.
That's what you could do with a personal home, isn't it? You can defer the tax on the gain just by putting it into another piece of property.
I believe you can do that. I don't know residential well, but in the commercial world, 70% of the folks who sell investment properties, at least in New York City, purchase another property to defer their gains tax.
And you want that. You want that as part of tax reform.
We need that. We need that. To the extent that goes away, and that's one of the things that we hear is on the table, and it's called the 1031 tax-deferred exchange. That's very important because with those exchanges, you get more investment, you get more jobs, and more liquidity.
You've got it now, but it might go away.
Right.
You don't want it to go away.
We don't want it to go away because right now we've had a setback with regard to the volume of sales. The peak of the market was in 2015. Activity now is down about 57% from then. If 1031 exchanges were to be eliminated, it would make selling more expensive. As you know from the London School of Economics, something gets more expensive, you get less of it. And if you get less of it, that's not good for somebody who makes a living by selling buildings.
You Googled me after I had a go at you. I know you did. I know you did. Okay, number three.
Yeah, number three is really the roundhouse punch that could really hurt the industry, is the elimination of the deductibility of business interest on debt. All businesses, but especially commercial real estate, rely on debt, and if that interest is no longer deductible, that could really be negative for commercial real estate.
So you're all in favor of tax cuts, but you don't want the give back on the other side of the fence.
Depends what you have to give up in order to get it.
Okay, I understand it's an equation, and you want it to work out in your way. Bob Knakal, it was better this time, I think. It was a positive message, and we like that.
Absolutely.
Thank you, Bob. You're all right. Thank you, sir.